Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the Rickshaw Man's pattern. The Rickshaw Man pattern, a powerful candlestick formation that can signal potential market reversal. This unique pattern is characterized by its long shadow and small body, offers valuable insight into the market sentiment and can be a game changer for your trading strategy. Whether you are a seasoned trader or just a starting out trader, understanding how to identify and utilize the Rickshaw Man pattern can significantly enhance your ability to spot key turning points in the market. So stay tuned as we break down these components of this pattern, explaining its significance and provide you with an actionable strategy to incorporate it in your trading arsenal. The Rickshaw Man is typically a single candlestick pattern that signals market indecision. It is characterized by a small doji-like body. This is the doji-like body near the middle of the candle with long upper and lower wicks. This unique formation was identified by a technical analysis known as Steve Nielsen in 1991, and it was described in his book as a Japanese candlestick charting technique. So let's look at some key characteristics of this Rickshaw Man's pattern. It is nearly identical. It has a nearly identical opening and closing prices. That means it can have a both equal higher wick and lower wick side. It has a small body near the candle midpoint. It has a long lower and upper wick indicating significant market movement during trading period. So now let's look at the trading strategy that we can use to leverage the Rickshaw Man's pattern. To effectively trade using the Rickshaw Man's pattern, we follow a few steps. Few steps that we can follow is, first of all, we identify the pattern, and these are the areas I have identified the pattern on the chart. And as we can see, this is a pattern of the Rickshaw Man's candlestick pattern. When you identify the pattern, you look for a single candlestick with a small body. As we can see, it has a small body in this area, and it has a long upper and lower wick. The open and close of price should be very close to each other. This formation is typically appeared at the end of a trend. As you can see, it appeared at the end of this pullback trend, the pullback phase of this trend, and it may appear at a significant support or resistance level. If we can draw this area of our chart, if we mark out both support and resistance levels, we can see these are areas in the price where we expect price to respect. These are support regions on the chart. That we are looking at. Support areas. Let me keep drawing these areas out on charts. We can see this area was a previous swing low. It's still an area of the chart. This is our support area, our resistance area, and this is the newly formed resistance area. These are areas where, if we see this pattern, it makes more sense. It has more significance when it appears at this area. Typically appearing at the end of a downtrend signals a potential reversal. When we see this pattern at the end of a downtrend or at a support or resistance area, it signifies a reversal or consolidation phase. The second step is to analyze the context. We examine the broader market context, and as we can see, market is making a series of, trying to bring my part 2 for us to understand the phase that the market is in. The market is making a series of highs, lows, higher high, higher lows, higher high, higher lows, higher high, a higher low, a newly formed higher high, a higher low. signifying that the market is in an uptrend. The market is simply saying it is in an uptrend and we are looking for bullish participants in the market. When we are in an uptrend or a downtrend, you look for significant support or resistance level which we have already marked out on the chart. So these are areas we have marked out on the chart that could be a potential reversal point on our resistance or our support level. By understanding this pattern context is crucial for interrupting its potential implication. So we have to wait for confirmation. The Rickshaw Man alone is not a definite signal to enter a trade. Because you saw the Rickshaw Man's candlestick pattern doesn't mean you should enter the trade alone. We have to wait for additional confirmations from subsequent candlestick. A strong move is in the opposite direction of the prior trend can indicate a potential reversal. So the moment we see this candlestick pattern, if we see a strong candle in the opposite direction, it further strengthens our bias. So as we can see this Rickshaw Man's candlestick pattern followed by this bearish candle, followed by this bearish hammer pattern before a bullish candle close above. This further strengthens our bullish reversal. Remember, when you see a hammer is a strong bullish reversal pattern signifying higher prices. So this is where you would want to enter your trade when price closed above your hammer after your Rickshaw Man's candlestick pattern. This is where you enter your trade. For a bullish reversal, you enter a long position when price moves above or high of the Rickman-Shaw candle. That's what happened when price moves above. You can enter at this engulfing, or you can go to the lower time frame to get a better entry. But I'll enter at this candle that closed above the candle's body size. This is where I will confirm my entry. For a bearish trade, you simply enter when price close below the Rickshaw Man's candle. As you can see in this area, after the Rickshaw Man, we saw a bearish engulfing. This is where we would want to enter our trade. Remember, the trade has to be on a support or resistance level, and as you can see, this was a swing area in the market, signifying that this area is likely to hold price. This was a previous support that is acting as a resistance now. So when price got to that area on the chart, we expect price to show some signs of rejection, and before it showed our candlestick pattern, our Rickshaw Man's candlestick pattern before a bearish engulfing. This is where we would enter our trade after price has closed below the Rickshaw Man candlestick pattern. Your stop loss is meant to be set beyond the opposite shadow of the entry point, the opposite shadow of that candle. So you set your stop loss above the opposite shadow, or better still above this resistance level. In terms of a buy trade, you set it below the candlestick, the Rickshaw Man candlestick low, or the low of that, the swing low of that particular area. This is where you set your stop loss. You can also consider using an average true range for your stop loss placement. Now, to determine your profit targets, you establish your take profit levels based on key support or resistance level, or you can use a fixed risk to reward ratio. So if you use a fixed support or resistance level, we are aiming for this resistance level in time of price, which will give us a 1:4. In terms of this sell trade, we can use a fixed risk to reward of 1:2 or 1:3. If we can't cite any support or resistance level that has been in the past, we can use a fixed risk to reward of 1:2 or 1:3 to set our profit target. Remember, I will recommend a minimum risk to reward of 1:2. I recommended this to ensure favorable trade outcomes over time. You can also incorporate this strategy with additional technical analysis. You can enhance to enhance your trading decision by combining the Rickshaw Man's pattern with other technical indicators. For instance, you can use the momentum indicator such as your RSI. Your RSI will simply help you to spot overbought and oversold regions in the market. You can also use your MACD to also spot your overbought and oversold conditions, and you can also use divergence to align with the potential reversal signals by your Rickshaw Man's candlestick pattern. Remember to always manage and monitor your trades while in a position. You monitor your trade. Once you enter a trade, you have to monitor its progress. Be prepared to adjust your surplus or your take profit or your partial take profit as the trade develops. That means you can make use of a trailing stop in this scenario. Always adhere to predetermined risk management rules. Always risk nothing less than 1% or 2% of your trading capital on a trade. In each that means in each trade you are taking, you should risk at least 1% or 2% of your trading capital on that trade. This is basically how we manage our trade for to stay on in the trading game for a long period of time. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. Always, if you found this video helpful, do not forget to like, subscribe and turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.